And we are live. It sounds low. That was an abrupt stop. How y'all doing, world? Welcome to another installment of the Pod with No Name. I am your host, Tully Garrett. Just wanted to welcome everybody. Hope everybody's out there being safe, COVID-free. If you're watching this on YouTube, please make sure to like, share, and subscribe. If you're listening to this on any other DSPs, just feel free to share it. Let's keep the dialogue going. Today, I have two people with me. Have David and Acquania, and we are talking about life insurance. So I thought that this was like an amazing conversation to have because in the Black community, honestly, we don't really have it. We don't really utilize it. And we find ourselves utilizing it or needing it or getting it when it's too late. So before we get started, Acquania, just wanted you to talk about a little bit about your business. You're also a fellow podcaster, so please do the shameless plugs. Plug. We're gonna put everything in the in the captions and everything, and pop everything up, the IGs, the YouTubes, anything you want. And yeah, let's hear a little bit from you. Word.
Right. My name is Acquania Escarne. I am the host of the Purpose of Money podcast, as well as the creator of thepurposeofmoney.com, which is a blog helping women build generational wealth $1 at a time. I am a wealth strategist and life insurance producer, helping individuals build wealth, level up, and invest in life insurance to build wealth. It's a great way to help your family guarantee a legacy. It's also a great way to do a lot of other things, which I'll go into later in our discussion. But I've personally used life insurance to invest in real estate, to provide college education for my children, and to protect my family and my future income. So we'll get into that, but check out thepurposeofmoney.com, and on Instagram, I'm at thepurposeofmoney.
Yep.
I'm sharing money tips all
up.
the time. So I love to have conversations like this because I think this is important, and I look forward to today's chat.
Awesome. A little bit about yourself, David.
Oh, I mean, that's a loaded question, man. I'm lucky to be here, lucky to be part of the conversation. I've been part of the DMV area for about a decade now, and just been thriving here. So that's what keeps me here. And
awesome.
I know a little bit about life insurance too. That's what got me into the conversation before we started doing this. And he was like, "Hey, you know some stuff, so why don't you sit on the couch and share your experience?" So that's why I'm here.
Okay, awesome. So can you tell us a little bit about like when you got started, how you got started, what made you decide to even get into this field? Because
absolutely. So I decided to get licensed in 2016 because of several reasons, but the primary one was I got tired of seeing GoFundMe accounts for people of color.
Right.
I know we can do better, and I wanted to be someone who could help educate people on how to do better. So I actually was coming back. I'd been living abroad for a few years. I came back to the U.S. and I discovered a ebook that's pretty interesting called "What Would the Rockefellers Do?" And in that book, they talk about how wealthy families, businesses have invested in life insurance as a way to create wealth for each generation, and using the cash value in life insurance policies to fund education, houses, initiatives that family members wanted to do, and everyone investing in this strategy so that the family never ran out of a legacy and always had money like the Rockefellers. And so I took that as a foundation to also, hey, I should get licensed so I can educate African Americans about this. Right. We could start using this strategy in our families. Mm-hmm. And so I took that book as the inspiration to get on the platform. And I also wanted to give people options that didn't require you to raise money on a website.
Right.
Because to be honest, young people, a term policy that's temporary life insurance that covers you for a certain amount of time can be affordable. It's for some people that are young and healthy, $20-$30 a month, right? So that's one way to do it. But then when I found out how you can really level up and use life insurance to invest in real estate and build thousands of dollars in cash you could access while you're alive, that's a strategy that I said can take us to the next level.
Right.
So I use both strategies. I sell permanent and term life insurance because depending on your situation, you need life insurance, period. Which one you get really depends on your budget and your finances. But what I provide people is normally something they can level up. So say you start with term because of your budget, or maybe because you don't need as much right now, but then later you want to convert it to a permanent policy, you can do that. So I'd love to kind of talk more. Do you know the difference between term and permanent?
I don't. One thing that I did think about was when you said how when like an instance occurs where someone passes away and then you create a GoFundMe. And I just wanted to just talk about a little bit from my experience. When my mother passed away, that was literally the first discussion that came up. And it was just like, yo, we got to put out a GoFundMe to get the bread up to like pay for this. And like, I'm so prideful that I just was like, I don't want that. Like, that's like shameful to me. You know what I mean? I grew up poor, whatever. If you know me, you know my story. It is what it is. But I don't feel like I didn't feel like I wanted to like publicize it. And I think that like the lack of knowledge and understanding is what had me at that predicament. So which is why I think this conversation is very powerful. Mm-hmm. So can you break down the difference between term and what's the other one?
Yes, and permanent life insurance. Okay, yes, permanent. I can. So I'll give you an analogy that a lot of people can relate to, right? Term insurance is temporary. It covers you for a certain amount of time. That time could be 1 year, 5 years, 10 years, 15, 20, or 30 years. Okay. I like to equate that to an apartment. You sign a lease because life insurance is a contract between you and the life insurance company. Right. Your lease is the amount of time that you sign up for. Most people will do 10, 20, or 30 years. Right. If you die within the time of your agreement, the life insurance company will pay your family the death benefit. That's the amount of money you've promised. If something happens to me, this will provide for my family. Right. So that's term. Term. It's more affordable because the risk is really not there. Only 1 to 2% of term policies are actually paid out. Life insurance companies know that. That's where they make their real bread and butter. Makes sense. So they're like, we'll sell it to you for a more affordable price. Right. We'll give you more bang for your buck because if something happens to you, we're going to have to pay. But the likelihood of us paying is so low. That's why we can provide it at the cost we do. But for someone who has a tight budget, this makes sense. Right. If you have children and you definitely need to provide college funds or pay off a mortgage or even income to sustain the life you've created, you should go for term if that's what your budget can afford, right? Permanent life insurance, and I want to say permanent because there's different types. A lot of people think it's whole life, but no. Permanent life insurance covers you for the rest of your life. Okay. But it's not whole life insurance. Whole life insurance is a type of permanent insurance. And there's several types. Some of them are invested in the market. Some of them are paid cash and interest, but not invested in the market. So that's why I don't want to call it whole life. Got it. But permanent life insurance is equivalent to buying your forever home. Ideally, when you purchase permanent insurance, you don't need to purchase it again because you're guaranteed to get this benefit when you die, and we are all guaranteed to die, right? Because it's a guaranteed contract, the life insurance company charges more for it because the risk is on them. Right. The minute you die, they have to pay out this money. It's not going to expire, right? How long you pay for it depends on the contract that you sign up for. Some of my clients, they only pay up until retirement. And then in retirement, it's paid up. There's no more money to put into it, but the death benefit is guaranteed. Okay. Some people choose to spread out the costs across their life, so they may pay for the rest of their life. But what they're paying is to guarantee their family's taken care of. Got it. So that's why I call it equivalent to that forever home or getting a mortgage. It's that long-term commitment. Right. But this is the product that has the more opportunity to it. It has higher returns than sometimes the stock market. It has the ability to be borrowed from while you're alive, so you can create your own bank.
Oh.
It has the opportunity for you to leverage this money to invest in businesses and other opportunities, and then you could choose to put it back or not. It also has the ability to build cash that you can supplement your retirement with.
Okay. I have a question about borrowing.
Mm-hmm.
If just like how you can borrow from your 401k, if you borrow from your 401k, there's fees associated. Is there any fees when you borrow from your life insurance?
It depends on the company. Some companies will charge interest,
Gotcha.
but not fees. But it gets a little complicated, and so this is why that conversation I have one-on-one with the person depending on the product, because we can structure it different ways. But essentially, it still benefits you in the long run when you are strategically using it and turning it into a bank that you're funding, borrowing from, replacing, not replacing. Depends on how you're using the cash value. But the biggest benefit for all life insurance is that it's tax-free income.
I did not know that.
So whether you get term or whether you get permanent, when you die, your family gets a check. It is not taxable by Uncle Sam.
Oh.
So not only are you providing income to maintain the lifestyle you work so hard to create, you're giving your family income that they don't have to give Uncle Sam a cut of.
Right.
That is the most valuable aspect. Besides the fact that it can pay your final tax bill, it can cover whatever expenses you were covering. And if you do it right, because I recommend you get at least 5 to 10 times your income, then you're allowing your family a moment of grace. They can have 5 to 10 years before they really have to worry about that money not coming in to cover whatever you covered.
And is that only specifically for whole life insurance, or can you also do that with the term life insurance?
All life insurance benefits when paid out upon death are tax-free income.
Okay.
The cash value in the permanent life insurance is also not taxable depending on how you take it out. Because you can do loans and you can do permanent withdrawals.
Right.
But when you're taking out money, a lot of times, if you're taking out initial premium payments, they're not taxable. That's money you put in after taxes, and it's not taxable when you take it out. But because you do earn interest, if you're permanently withdrawing money that earned interest, that could be taxable.
Got it. And
but
that's
a lot
why
of times
it's
not.
Okay. Wow. And so that's how it gets specific.
Mm-hmm.
That is a lot. Like, I've never, like, because once again, like, you only, for at least for me, like, I only thought about like life insurance. Like, I'm 30 now. I'm like, all right, I'm not married. I will be married, but I'm like, all right, I'm not married. So if I died, like, let me not do it now because I don't know. But I do have life insurance through one company, and I have like a personal thing, but it's very low. And so I say, and my sister's like my beneficiary. And so I'm just like, all right, well, I'm not thinking about it. I never thought about it as a way to potentially like help create general wealth in that way to where I can borrow from it. So even though it's term, because I don't have
So term does not build cash value.
Okay.
That's
all right.
well,
That makes sense.
Term is simple. Term is
Right.
like, you die, I pay.
Right.
You don't die.
Okay, so
right?
I can't pull from that.
You can't pull.
Okay, so that's something that's definitely like good to know. Like if you have a term policy, don't look to pull from that. Don't say like, oh, Tully said, Acquania said, like don't do that. Like we definitely didn't say none of that. So all right, that's absolutely good to know. Okay. Man, that's still so fascinating to me. But David, how did you choose, or did you choose to get into life insurance? Because we had a conversation beforehand, and you guys seem like you guys are actually like really doing it. We gotta have a conversation offline. Like you guys gotta be my friends because I need more friends like that. You guys are active, and I like that.
Mm-hmm. So I was introduced to life insurance quite differently than Acquania was. You being coming back and wanting to get into it and educate people. For me, it started off as a job opportunity that just didn't really align once I got some more information, but I understood the value. And for me, creating generational wealth was, or really is, just my ultimate goal.
Right.
And I understand getting down to meeting that goal, you're not going to do it by just getting rich quick. It's more of a build wealth slow. And so I had an understanding of the impact. I didn't know anything about that you can kind of turn it into your own bank until much later, but I knew at least the protection mechanisms and how it was going to work for me, right? Defensive, offensive strategies from a financial perspective. So I got right in when I was 22. And what changed was a fraternity brother of mine, a chapter brother of mine. This is one of the guys that he can do whatever he wants to do when he sets his mind to it. So he was studying history, switched to finance, figured he wasn't going to make any money being a history teacher, right? So he got out and he was wildly successful his first year. Right. And once I found out about what he was doing, I'm like, okay, James, tell this other dude that's managing my stuff that you're going to be managing my stuff, right? I'd sign the paperwork. And then being young, being aggressive, and us kind of speaking the same lingo, he told me, hey, here's how you can use it as a financial vehicle, not just for these other things. So he set up his interview with me, went through everything and just like the different plans and how it can be, I don't want to say rigid, if you will, at least a perception when you think about life insurance, right? It's like life insurance. There's nothing sexy about when you're not trading, right? You're not like a day trader. It's building wealth slow. But he showed me how powerful it is. For example, when you're building up this cash value, this is when you really open my eyes to what you could do with the cash value. And he showed me the projections based on the different policies that I can have and what I can do like, hey, Dave, this is what you're going to have projected at 50. You can go out and buy you a beach house at 50, 55 with this cash value, right? And it's like, you can pay it back, but if you don't, it's just a slice of the pie that doesn't get paid out, right? Let's say, on a $500,000 policy, I borrow 100, 400 gets paid. So it's still a win-win situation. So in my mind, if I want to go buy a beach house or a multi-unit, that's appreciating for me. Again, what I want to do is just create generational wealth. Going back to your story, I take a little detour, right? Going back to your story earlier on, that's not uncommon amongst us minorities, right? Where they're just, for whatever reason, we haven't been taught or instilled that we need to pass something down. And that's where our counterparts, they tend to kind of get ahead of us, and it's no one's wrongdoing, but now that we're aware of it, and now that this is something that we can alter while we're living, let's think about how we do that, right? And then so it just rung a bell for me on so many levels. And it's like, hey, Dave, even if you don't touch it, when it's time for you to retire, you can use it as a way to supplement your retirement, almost like as a reverse mortgage, right? Where it pays out your cash value, and it basically pays you a salary. So, and you can structure it however you want on the back end. You can use it for whatever. So for me, it was an attractive thing. And I view that as, hey, you can get to this cash value. You tell me you need it. It's in your bank account tomorrow. Wow. So for me, that's my safety net. Right. I don't need to look into my checking account and say I need X amount because I know I got this cash value. Right. So this cash value for me today, mind you, I was 22 when I set it up. I'm 35 now, just turned 35 a month ago. And it's at a point where my dividends will be able to pay the policy. So the policy, if I choose to not pay for it, will self-fund itself. Oh, wow. That's where it's at. So that's just, a little bit of background and my experience with it. Earlier on, I'd say about 27 or 28, I was able to pull some of the cash value and use that as a down payment or part of the down payment for a couple investment properties. We were actually talking about that before you had played the song, so we didn't get to finish it. But it helped me buy some investment properties. I got into flipping now, so that helped me continue to fund one of the deals that we had just closed out. So it's been, I've put it to work so I can speak to it, not just from a conceptual standpoint, but from how it's working for me. And I'd say, it's powerful. Mm-hmm.
That's amazing.
Absolutely. Yeah. I have a similar story. And that's why I'm a fellow real estate investor, but I'm afraid of flip. So I've always done buy and holds. That's when you purchase property and put in a tenant and hold on to it. Got it. And then sell it later. And it's the same thing. My husband and I, We saved for 3 years when we were living abroad. We weren't paying for housing here, so we were able to save what we would have paid for housing. And then came back, and in 2016, we purchased 3 properties. We purchased a rental property in Philadelphia, our primary house in Virginia, and my mother-in-law a condo in Florida.
That's
that
amazing.
one we
Nice.
contributed to with his siblings, but still, most people can't put down 3 down payments in 1 year.
Right.
But we were in a very blessed position because we had the savings. We were saving in the life insurance policies even longer than 3 years, because we got life insurance a year before our marriage.
So you were able to, so you pulled a little bit out of the life insurance to help fund all 3. Wow. Okay.
Yes. Yes.
Wow.
And since you're in the DMV, property here,
the
down payments are quite high.
That's a fact.
So that's a lot of cash.
Yeah.
And I, being the financial savvy person I am, would never liquidate all of my savings to purchase a home. Unfortunately, some people have to. That is how they can afford home ownership, is they use a lot of their savings. But as I tell my clients, you can't use all your emergency fund savings or your savings at all to purchase a home, because then when you move in the home and something happens,
now you don't have
any money.
Right.
But we were in a position where we were like, oh, we got this life insurance cash. It's just sitting here. I called them up. I said, I like to take out $40,000. That's what we did. And they were like, okay, we'll send you the check. How would you like it? So that helped a lot for us to be able to do things, get into real estate investment outside of state, and to bless someone else in our family, right? Which is really important. So that is just one example. And, and I had the choice to pay it back or not. I mean, that's the choices you have when you have policies with cash value.
Right. And that's actually like an amazing point. So if you if you choose not to pay it back, then I'm just reiterating what you guys are saying. I'm not like like, you know what I mean? But if you choose not to pay back the policy, it just deducts from what the ending term is going to be. So that's like a beautiful way to actually utilize it to do virtually anything you would like to do. I think I want to ask, not getting into specifically your both of you guys' policies, but like, I can't even say like on average, like what would a policy cost, but because I know it varies. Like I know it's like depending on age, health. Is it gender? Like, I don't know.
Yes.
Race, maybe?
Yeah. No.
Okay.
So not race.
Okay.
This is the one thing where everything on paper, you never identify your race.
Okay.
However, yes, it is based on health and age. Those are factors that can really determine what your risks are or what the insurance company's risks are. Women are cheaper to insure than men.
Because you guys live longer.
Yes, we live longer, but we tend to live safer lives, according to the mathematicians out there. So it is cheaper to insure a woman over a man. However, if I'm a woman with health conditions, it could be similar situation to a healthy man. It just depends.
Right.
But they do treat men and women differently. They also will look at, people don't realize this, but speeding tickets, information that's publicly available in LexisNexis that might reflect your behavior.
I understand why, but like that just doesn't. I'm like, what?
They're evaluating your lifestyle.
Exactly.
So
Got
that's
it. Okay.
If maybe if I can put the analogy in general terms, when you want to lend somebody some money, like you want to, okay, what's their background in paying people, right? Is this person going to give me my money back? And it's similar thing, but significantly more complex, where they're evaluating because they are betting a lot of money that this person is going to live a very long time. So what are the things that I need to evaluate to make that determination? And it's hey, if this person has got a bunch of speeding tickets, the likelihood that they're going to crash probably goes up compared to someone I evaluate that doesn't have anything.
That's a fact. I was actually talking to my homeboy today, quick side note, and he literally, like, I'm not trying to come at him, like, I was like, damn, this shit sucks, but he literally just just leased a new car. I'm pretty sure it was a lease. I think he said it was a lease. And crashed 4 hours later. Totaled the vehicle. But that was like his fourth, maybe fifth offense. And so, but I told him that we were having this conversation, and I was like, yo, bro, like everything that I found out, I'm bringing it back to you. Cause he has, he has his fiance and 2 children. So I'm like, this is important for you to understand that, to be able to utilize. And it's a lot. So
that's a factor. I mean, wouldn't you want to know? I'm about to bet thousands on this person.
Right.
If
hundreds of thousands.
Hundreds of $1,000s.
Yeah.
If they have 5 speeding tickets in the last 5 years, I might want to charge them more.
Right.
Or if they smoke a pack a day, right?
Exactly.
Or like,
oh wait, they ask about that.
Yes.
Health, medical, you do.
Because I was trying to like look at the time and stuff, and I was like, oh, like we could get into it though, but like, so is it mandatory that they do physicals on everyone?
No.
Okay.
So I work with different companies.
Yeah.
Some of my companies will have a medical questionnaire. Others will actually have someone come to your home who will take blood and urine and ask you questions as well.
What?
What people ask, it depends on the company.
Mm-hmm.
If they don't require a medical physical, it doesn't mean that they're not as good of a company. It means they utilize other avenues to really get the information they need so they can avoid it.
Gotcha.
Right? They do look at medical records, but I've been able to successfully, in my case, get clients who, even with previous cancer diagnosis, they've been able to get insurance based on their health now.
Got it.
So there are some things in your medical history that could make you uninsurable, but there are other things that could have happened, and now that they are resolved, you are insurable. So that's the other thing. People need to be careful about their current health. If you have medical health issues in your family, people get diabetes at 40, you may want to get insurance before 40.
Right.
That's just an example, but I'm just letting you know, because they do look at history, a history of cancer, history of diabetes, and other issues. And if you are more susceptible to certain conditions because you're overweight or because of diet, that can impact the price that you pay for insurance as well.
Okay. All right. That makes sense. But I didn't know that they were like coming to your house, like asking for the blood and urine. I'm like, oh, that's a little invasive. Like, I think
it just depends. Not everybody, but
right.
some companies do. But that's one time in your life. And then every time you want another policy, which you can have more than one life insurance policy.
That's a fact. Yep. I knew that because once my company was like, hey, you get this policy. If you die, here's a couple bands. I'm like, oh, okay, cool. But I know I can open up more elsewhere. And so I guess I think we could take a break right here and then come back and then talk about, a little bit about what type of plans, like not specific. Well, actually, yeah.
I can
if
talk
you
about
have
plans.
Any, yeah.
And then I also want to talk about why your insurance through your job is not enough.
Yeah, facts. Okay, so all right, we're gonna take a quick break and we'll be right back. All right.
There we go.
Let's do this.
Yeah, we
Back
are
at it.
back. Right. So all right, yeah, let's just dive right in. So we was talking about various policies, different plans, possibly different companies. We brought up Primerica.
Yeah, so I am an independent life insurance agent. So I do sell life insurance, and I choose the company that's best for my client. I ask them a lot of questions about their current health. We go over budget. We do a full financial analysis, and then we look at their needs. So I'll give you a quick tip to get a rough estimate of what you need in insurance, but then it all depends, right? So dime. Everybody remember that, right? I'm a dime. Y'all know how to say DIME.
Yeah,
so,
dudes can't say we're a dime though. That's a little different. But
so D stands for debt, and so you want to know what's the total amount of debt that you have. Who do you owe money to, and if you were to die, would they come knocking at your family's door?
Right.
So that's your debt number. I is for income. You want to do, my preference is 10 times your income.
Right.
So multiply your income times 10, add it to your debt. M stands for mortgage. How much money do you have left on your mortgage that if you die tomorrow, this is what the bank would expect to either be paid immediately or over time, right? So you add that. And E stands for education. Education could be for your family members or anyone else that you would like to provide education to.
Right.
The way I kind of calculate that is $50,000 a year. You want to go to a 4-year university private, you're probably looking at $200K.
Right.
That's your education number. If you have more than one person you want to educate, more than one child, then you multiply by the number of children.
Right.
Add up your DIME, and that is the minimum amount of insurance you should be considering for yourself, because that will give your family the money they need to make it through the next 10 years after you die. And if you have young children and you die young, you need to be thinking about providing for them food, shelter, and when they eventually go to college, education.
Right.
So that's why it's your starting point. But for my clients who are looking to get tax-free income to supplement retirement, or they want to use it as a bank to do investments and then fund whatever it is they want to do, other businesses. Or we didn't talk about this, but if you own a business, you have a partner in that business, you can get life insurance to cover you as a partner in the business, that if something happens to you, the death benefit goes to the business.
Oh, wow. Okay.
Which allows your partner not to have to fold up the business and shut up shop just because you died.
Right.
Okay. And that's really important, because people, especially when you're just starting out, you're a new entrepreneur, or you're literally robbing Peter to pay Paul, you're not thinking about, well, what if I don't have my business partner with me one day? How would I pay my staff, pay my bills, continue to function in my business?
Right.
That is why you could also get life insurance specifically to cover the business interests, because not all family members want to take over family businesses.
Yeah.
So if you die and your partner wants to continue to remain in business and your family has no interest in taking it over, get life insurance to cover your ownership stake. And then that allows your partner to remain whole.
Wow. Okay. Whew. So there's probably a ton of insurance companies. I kept mentioning like Primerica because of I know someone that's affiliated with it. You mentioned offline that they serve, or they only give term life insurance, which immediately to me, I'm like, I'm okay with that. I think that after this conversation, I know now I want to go the whole route. But what are some companies, like for people who may not have like the financial means to set up like a consultation, or maybe just afraid to even like reach out, because hopefully I would like for people to say, hey, I learned from this. I want to reach out. I want to learn more. I want to set up consultations. I want to get this whole thing going. But for those who may be a little bit shy, are there any companies that you may recommend, or what do you recommend they do in regards to going about like getting this life
offer
insurance?
A free consultation.
Oh, okay.
So,
well, then never mind then.
Right. Click the contact button, get on my schedule. But real talk, like, because I work with different companies, I can get nationwide. I can do National Life Group, which is one of my favorite. But a lot of those prefer that you go through an agent so that you're well versed on the information and what you're buying, right? I definitely want my clients to be informed about what they're buying and understand the pros, the cons, and all the details. So I do recommend you work with a licensed life insurance agent, but if you want to Google it, you can, and you can do the online searches and putting your information. My only caveat to that is sometimes when you're putting in data into a software that just spits out quotes, it's not taking into consideration nuances like your health conditions, for example. And it's estimating what it thinks you'll qualify for as far as a rating. Right. But when you work with an experienced agent, they can pretty much pick the right company that has more flexibility. Because, for example, I have one company. If you tell me I'm in bad health and I just want to cover final expenses because I know I'm not going to pass anybody's medical test, I have a company for that. It's going to cost you a little more because they don't have a medical exam and they don't ask a lot of medical questions. But I can give your family the coverage they need to bury you and to cover your final tax bill or your student loans, because people assume that those die with you, but they actually don't.
Please, like, say that again, because I have like a friend of mine, like, I love this man to death. He cool as fuck. He's like, yo, fuck them student loan bills. I'm like, you can't.
Good luck.
Like, you can file for bankruptcy and not get that off. So when you die, you're essentially passing that to your family, right?
So
like your children or something? Okay.
It depends. And that's why I want to be clear.
Right.
Student loans, if they are federal, in most cases, will get forgiven. Okay? But if they are private, that's the higher interest rate. You signed a contract with a company in exchange for money for school. They've been charging you interest the whole time. Those people want their money. Right. That's just like you owe somebody, right? And you dying is not always a justified reason to suddenly erase that bill, right? You borrowed that money, you got the education or didn't, and now you owe it. What can happen, though, which people need to keep in mind, is even when debt is forgiven, it can still be taxable. Oh. The IRS may consider that a gift. Right. So now you've had $50,000 forgiven, but now we're going to treat that as $50,000 in income. Gain.
Yep. Okay. Taxable income.
Right.
Gain. Okay.
Taxable income, which, depending on how much money you were already making, could change your tax bracket. Then now you have a final tax bill. Right. In addition to that, when you don't properly do your estate planning is the process that you go through to create a will, a living trust, a medical directive, basically all the paperwork to say, this is what happens if I'm alive and I need life-saving equipment or medical attention. This is what I want you to do with my stuff when I die. That's the will, right? And some people who have complicated asset, a lot of houses, a lot of property, a lot of money, they will even develop a trust. And that trust will hold the property. And then when they die, there's instructions on what to do with the trust. There's a person, they call them executor of estate, who is responsible for telling everyone, this is your car, you get the jewels, this money goes to charity, and they dish everything out. Divvy it up, yeah. If you don't do any of that stuff, because you thought, oh, I'm going to live forever. Why do I need a will? Why do I need a medical directive? And then you die suddenly, of course, unexpectedly. Right. Your state, every state's different. Your state may have a process called probate. Probate is a court process where the court system, based on the laws of your state, will determine how to divide your assets because you didn't tell anyone how to do it.
No, I don't like that.
Right. So now a judge is saying, well, based on the law, you got 3 kids, 1 illegitimate. Now all property is equally divided amongst them all.
And you ain't want to do that or...
Right. Yeah. Or... oh, well, in this state, all property goes to your spouse. Your children get nothing. What do you know what I mean? Like,
yeah, I can see how it could get.
So if you want control over what happens to your stuff, you got to have documents in place to say what happens. But the other thing people need to realize is when you don't properly plan for your death, including getting life insurance, you may also have a family member who is now financially responsible for the probate process because courts aren't free, right? And in some states, the fee is the percentage of the estate. So let's just keep it simple. You have a $200,000 house. In your state, probate is 10% of the value of the assets. What's 10% of $200,000?
20 bands.
Now, we talked about families going on GoFundMe, right? Because they can't pay for funerals. How many of your family members can you call right now and ask for $20,000?
Zip zero.
And they will say, sure.
Yeah.
Here.
Right.
When are you going to, you're not going to give it back? That's okay. Right?
Right.
So guess what normally happens to that house?
It gets sold.
Exactly.
Yeah.
But let's just say it's 2008 and you bought that house for $200,000, but it's worth $150,000. And now you have to sell it. And you still have to pay probate costs. Is that really the best time for your family to sell a house?
Right. It's really not. Yeah.
So if you had purchased life insurance for a couple bucks a month, you would give your family the option to sell the house or not sell the house. Now they have the cash to pay off the house and they get to avoid probate because you had a will.
Yeah.
Right? But because you didn't plan, somebody has to come up with $20,000. And they have to sell the house, and they can't even keep it. They they paying for probate, but then they can't even keep the house.
Right. You might as well. Okay, I see exactly what you're saying.
So,
damn. And so you guys are also discussing switching your policy. So, let's say you start out with term. All right, I'm up now, right? Hopefully, and then now I'm gonna switch to whole life insurance. How does that process go? Is it an easy process? And what are the ramifications with it? Are there any tax implications or?
It depends on the company, but most companies who allow you to get a term policy and convert it to a permanent policy will allow you to do so sometimes just by filling out a piece of paper.
Oh, okay.
The companies that I work with, fortunately, will also consider you at the same health that you had at the time of the application. So if you were a young, healthy 25-year-old male and you decide to convert your policy at 35 or 40, you can do that by filling out a piece of paper, and you can still be considered a young, healthy male. Even if you develop diabetes, sometimes you don't even disclose the health condition because the health is not reviewed.
Right.
But you will always be reevaluated based on your age at the time of the application because you are now older and closer to death, right?
Right.
So you're not going to get the price of the 25-year-old male, but you will get the health category of the 25-year-old male. That's how they normally work. But some companies may require another medical exam. So it really depends on the company.
Okay.
So, Acquania, you bring up something that's very important. Me getting into my policy so early at 22, I think has been very beneficial in my ability to use it for the things that I want to do. I remember as I was actually going through the process of purchasing more, not doing the conversion piece, but it's like, hey, I'm making more. It's time to make that adjustment, right? Commensurate with the dime formula, our own version. And, it was, it was interesting because I got a projection based on what my age was now. Well, at least not now, but at the time. And he was like, hey, you might want to act like now because you're in your age, 29. This is when we're having a conversation. When you turn 30, your numbers look drastically different. I can run an illustration and show you the difference just from 29 and 30, what your projections, look like by year. And it is a material difference in my opinion. So just for the younger viewers that you have out there, if you're considering it, just get yourself locked in a very basic policy that's really just a couple dollars. And, sometimes getting more or even changing from term to life is just, or term, well, making that change can just be filling out a piece of paper. You know? It can be as easy as that. But you do want to get locked in as early as possible, not to discourage people who are a little longer in the tooth. You can still benefit from these things, but I'm speaking to the younger folks who are, might be on the fence. Hey, go do it because we're living proof in how you can make it work. And again, to your anecdotal story earlier, that's, and what you were just talking about. These are ways that you can have your family protected, and you can have that at a very, very early age. And that's pretty important.
Okay, man, that's a lot. But it's a lot in a good way. Like I'm so happy that like we had this conversation because, and I'm not trying to wrap it up yet, but like, like I really think that like this is like very like needed within like the minority community because, we always talk about like, for instance, like I drive a Honda, like, yeah, things are cool. Like I can afford to pay $500 a month. I don't want to do that, but like you can pay $500 a month and like drive a Benz, but it's like, knowing what I just learned today, I can now take, and I'm not saying that it's $500 a month, but like I can now take the additional income that I could potentially put to a luxury vehicle and then set that up for like set up life insurance for my future family and things like that. So I think that that's very important to like mention as well.
I can give you an analogy. I think that's very important and it's so true because putting money like that into an asset that depreciates, cars do. As soon as you drive them off the lot, as soon as you let them get too old or put too many miles, it's not as worth as much, right? But life insurance tends to grow with you and earns interest on most of the time an annual, sometimes 4 times a year basis.
Right.
But just an example, because most people don't realize this, you can insure children. And so I have policies on my children where I'm investing money in for them now that they can use when they're adults for college, for wedding, for down payment, for business.
Oh, that's the Gerber. Gerber. Oh, no?
Everybody, the Gerber's an option.
Because I be getting the Gerber ads. I'm like, ain't no babies here. I'm like, where the babies at? Like, I don't. Okay.
Other companies provide this.
Right.
And the reason it's a good decision is because, one, most children who are young and healthy, they're super inexpensive to insure.
Oh, right.
But then you can pay that policy up before they even become adults, and then they're covered. Like if something happened, accident, life, and they weren't insurable after that accident, they would already have this policy in place to cover them. And I'll give you an example. So a 1-year-old with one of my companies, about $500 a month, you start the policy, you pay it off by 16, and that'll give you $1 million policy. So 1-year-old, $1 million policy. Children can get as much insurance as their parents, but no more than their parents. You can't insure your kids for more than you insure yourself.
Right.
So if I have $1 million policy, my son can have $1 million policy. He's 1. I'd say I'm going to do $500 a month, because to me, when he's 16, that'll have $100,000, $200,000 in it. And it's $1 million if, God forbid, he passes.
Right.
But if he doesn't need the money, say he applies to colleges, gets a full ride, scholarships, everything's taken care of. Well, now you just let it grow.
Right.
And just let it sit there. But he has, before he has any kids, $1 million policy, right? The other benefit to all of this is, unlike a 529 plan, for those who don't know, a 529 plan is a investment specifically for college expenses.
Okay.
You can invest in the 529 plan for your state, or you can invest in other states. But when you invest in your own state, you can also write off some of your contributions. They're tax deductible for state taxes if you're in your state plan for some states. So this is a benefit. If you're tired of paying all these taxes and you want to break, maybe you should put some money in your plan.
Lower your taxable
lower your taxable
income. Yes.
So what I chose to do, my husband and I, we have Virginia plans because we live in Virginia, and we put in the amount that allows us to lower our Virginia taxes.
Smart.
But anything over that goes into the life insurance.
Oh.
Because what if my son grows up and he's like, I want to be an entrepreneur. I've watched you. I got a business plan. Here it is. This is how I'm going to make money. And I know he could do this because my son has sold rocks to people for $20. And I'm like, who bought a $20 rock?
That's crazy.
Somebody
bought it.
Right?
He sold sodas and lemonades out of our refrigerator to his friends. So I know my son could do a business, right? 529 plans are only for educational expenses. So if you save all your money in a 529 plan and then your kid's like, I ain't going to college.
Yeah, all that money go to waste.
You can take it out at a tax penalty. If you spend it on non-educational expenses, now all those tax breaks you got, you're going to get a hit on.
And it's probably something insane, like 34%.
It's going to be whatever it is at the time you try to do it.
Right.
Because that is subject to change.
Right.
But cash value and insurance policy, I can use it on whatever I want.
And why should you be penalized because now this particular investment, the 529, because you've locked into a particular vehicle for a very specific purpose.
Right.
If that purpose isn't fulfilled, it's you don't really receive that benefit. So there's a couple things numbers wise that you glossed over that I really want to emphasize, right?
Yeah, I heard 500 a month, and I was like, I hope people that's watching they'll be like,
hold on, but think about it, right? Okay, yeah, 500 a month. I mean, this is ballpark. We're spitballing
Obviously,
here, right?
It varies, yes.
Right, but let's say 500 a month. When the child is 1. Think about the benefit that she said when the child is
$1 million at 16.
Well, before, so the cash value, you said 100, 200. Don't quote us here,
right.
but you can probably, it's realistic to have a 6-figure benefit for your child when they're 16. That's a cash value that now at 16, 17, 18, it's 6 figures, right? Your child can do anything. You can forego school and go buy a business if you wanted to do that. You can go, you can do both. You can go to school and run a business. I mean, the flexibility and the options are limitless when you think about it. You can go buy a multi-unit and rent out at the school, and make money. I mean, it's you're not locked into just education. So this is where it's important to have a financial advisor like Acquania that can help you navigate what your goals are. Think about what she was just talking about. Hey, we do have a portion of that to lower our taxes. So that's a benefit to us right now. We still have a little kiddie pool that's designated for education. We're not putting all of our chips into it, but then we're really supplementing that with the life insurance policies. So when, you know, your children get to of age, not only will they have education, but then they got other things. They got seed money for whatever, you know, he's selling, you know, $20 rocks, you know, and sodas and stuff like that. Right. You know, who knows what he can do at 16, 17, 18. He'll probably be ready for it. He'll start selling clothes. Like he sounds like a kid that it's like, okay, mom, you want to give me a couple $100,000 at 16, 17, 18, watch what I bring back home. Right. You know, you're making that happen for him.
Like, why can't we have an advantage? Everybody else gets buildings and loans and bankruptcy several times. I mean, come on now, give us an advantage too. I want my son to have an advantage. I want him to have options, right? It's just options. And I think that's what we limit ourselves from when we choose to invest in depreciating assets over assets that give you options. I'm not saying I don't like nice things. I love vacations. So most of the things that I find to put my money into are memorable experiences for my family, right? You're not going to see me. I don't drive a luxury car, but I will do a luxury vacation. Right. But it balances out, and I have a foundation financially that I can afford to do that. It's not like I'm taking luxury vacations for Instagram and then I can't pay my bills when I get home. Right. That's not what we're doing, right? Yeah. So I think that's what people need to realize is everybody has a choice. And you're right. It doesn't have to be 500. Maybe it's 200. Maybe it's 300 a month. But maybe it's
50, 100. Like whatever you can do to get that policy started and to grow over time. But what I noticed, the common denominator in what you're mentioning among wealthy people is delayed gratification. So it's really about what are you okay delaying? For me, I don't care about any of that shit. Right. This is Costco's finest, dude. Like I don't care with my dad's shoes. I just don't care because for me, like my money needs to be working. I'm not going to be the only one working in this me and money relationship. Like just as hard as I'm working to get it is just as hard as it's going to work for me. You know, I started working at 13 and I worked on a golf course carrying golf clubs. And I noticed that, you know, Tuesday, Wednesday, Thursday, these people that I'm carrying clubs for are doing something very different than what my parents are. My parents are going to work. These people are on a golf course. And, you know, for me, you're out there for 4 hours with them. You talk to them and you hear their story. Some of it is built from generational wealth. Other is, you know, but really it's delayed gratification is that common denominator, right? They do have nice things, but, you know, it's how they go about it. You know, some of them may still be driving a 10-year-old, you know, whatever you want to call it, you know, and we got our versions of that, you know?
Right. I wanted to ask too, like before we go, if you had to have like words of wisdom to someone that's looking to get into it. I think I know what yours is, but you know, obviously like go again, Dave. You know what I mean? But like, honestly, like what is like, if you had like a statement that you had to give to someone to say like, hey, you're getting into this. This is what it is. This is what, cause I've taken a lot from this and this is not the first time or the last time that you guys are going to hear from me. Like I really want to like get more into it. I've been like teetering around and I get the policies in the mail, but now that I actually know someone, it's like powerful. So I just wanted to know like if you guys had any like parting.
Start early. I started saving for retirement at 16 with the Roth individual retirement account. And I've consistently saved and invested because you cannot save your way to wealth. I want to be clear. And I have numbers for that too. But you save, you know, about $300-400 a month for 30 years. You probably will end up with $150,000 or $200,000. Right. But when you invest that same amount of money, you'll get 1.2-1.3 million. There's a huge difference. So you do need to do both, and it helps to start early, but it's never too late to start. I have clients in their 50s and their 60s. I got to meet you where you are. So I do meet people where they are, and understanding finances is the foundation that matters. I tell people all the time, you don't have to do get rich quick schemes. You don't have to do risky investments to establish 7 figures in wealth. I know that for a fact. So I'm not sitting here saying, oh, in theory. No, I know that for a fact. And the reason I want to say that is because some of my clients, when they really know about me, because investing at 16, I am a hotel owner now. I invest in real estate.
Yeah, you do have that in your bio. I peeped that. I was like,
yes,
we got to talk some more after this. Yeah.
So I purchased my first hotel last fall at Hilton.
Congrats.
I'm in the process of purchasing more hotels right now. And I'm a passive investor. But everybody doesn't have to do that, right? The way I was able to do that, though, was quite simple. Started early, invested consistently. And I have clients who are millionaires solely based on investing in their work retirement accounts, investing in their own home. So not multiple homes, just their home.
Wow.
And not taking on a lot of debt. When you have most of your paycheck going to debt, it is going to be a little more challenging for you to build 7 figures in wealth.
Right.
So you got to get rid of the debt. But you can build 7 figures in wealth, investing in your work retirement account, purchasing your own home, and not having a lot of debt.
Okay.
So start early and be consistent.
Got it.
So she just gave the blueprint,
right?
I'm just,
the gems,
and left me maybe like 30 seconds to give my elevator pitch, right? So, everything that Acquania had said and more, right? I would want to say starting early, you benefit from what's called compounding,
right? Compound interest.
Yeah, compound interest is a very, very, very powerful tool and formula. Like I really don't understand it, but I know it works, right?
It definitely
and that's 22, 35 now, with the cash value and just with anything, your Roth is probably amazing starting it at 16 because of compounding. But I would say, to be oversimplistic is to just set a financial goal. Have it challenging, but not so unattainable that you're going to be discouraged. Right. For me, it started off, by the end of this year, I want to have X amount saved. Right. And then maybe the next year, it's like, okay, now I know I have this amount. I want to identify an investment opportunity that I can use this. Right. And then every year just kind of readjust and rebaseline maybe that 1 or maybe 2 goals, based on just past performance. And it's just everything is a stepping stone. Right. And when you think about everything as a stepping stone, you continue to grow, continue to build. And then when you look back, you're in a different place than what you were. But, it's be passive, but you have to overcome that fear of not knowing about it. I think that's the biggest challenge. It's like, well, I don't know about that, so I'm not going to do it. And you have to overcome that fear. Still be, risk averse and make sure that you're informed and all of that. But don't be scared to do something that's different just because it's something that you've never done before or your family hasn't done before. Right. That's how you're going to change your narrative. That's how you're going to alter the course of what you're trying to build and what we're trying to build. So that would be what I add to what you said.
Man, thank you guys. I really appreciate you guys, David and Acquania. I really appreciate you guys for stopping by. Man, I think that's a really good point to end it on. If you want to learn more, please reach out to Acquania. She's obviously a wealth of knowledge. We're definitely going to put your information in the captions. We're going to pop stuff up. Make sure that, people reach out. I hope people really take the time out to reach out, because I'm definitely going to try to learn more about this. If you're watching this once again on YouTube, please make sure to like, share, and subscribe. And if you're listening on the DSPs, please make sure to share this with your friend. If you learned something today, shoot it to a friend. Just be like, hey, this is something that I picked up. I don't know if you thought about this, and let's continue the conversation. But once again, my name is Tully. This is another installment of the Pod with No Name, and we are out. Thank you. Thank you, guys. I appreciate it.
That was good.